Hello, everyone, and welcome to another episode of the Investor Financing Podcast. And I'm your host, Beau Eckstein, and today we have a great guest. I'm not going to be presenting by myself today, and I just was really impressed and thought this was a really good topic for people that are investing in multifamily. Our guest, Jacob Ayers.
So here's just one translation I'll make between jiu-jitsu and real estate, and I won't go on a tangent, but we kind of talked about overcoming that fear of picking up the phone and calling a seller, right? Well, if I wake up early in the morning, go to 5:30 a.m. jiu-jitsu, get strangled for an hour, and then I'm looking at my emails for the day, or I'm looking at, hey, who do I need to call? Nothing seems so bad after that. It's like, I just got strangled for an hour. I can handle a phone call.
Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. And now, your host, Beau Eckstein.
Hello, everyone, and welcome to another episode of the Investor Financing Podcast. And I'm your host, Beau Eckstein, and today we have a great guest. I'm not going to be presenting by myself today, and I just was really impressed and thought this was a really good topic for people that are investing in multifamily. And we're going to talk about seller financing and creative deal structuring from somebody who's actively doing it and actually has a deal to talk about, which he was very creative on financing. Our guest, Jacob Ayers, resides in Houston, Texas, originally from Oklahoma, I believe. And he's also a host of the Real Estate Way to Wealth and Freedom podcast, which we'll dive into that. And I kind of get from the title of the podcast what the gist of it is. And that's to own real estate and become financially free and create a lifestyle that we all want. And so we don't have to work a 9 to 5. But Jacob, thanks for joining us. Will you give us a little bit more of a background about yourself?
Oh, hey, man. Thanks so much for having me. I am pumped to be here. Yeah. So a little bit about myself. I'm just a regular guy. I just turned 31 years old. So it's starting to feel a little bit old. I'm no longer in my 20s, but still working like I am. But I guess going back, I was born and raised in Oklahoma, grew up like so many people out there, Beau, in kind of lower middle class mindset. The blueprint was to go to school, get a good education, study something difficult, get a good stable job. And that was where my blueprint ended. So I did all that, went to Oklahoma State, studied engineering, took me down to Houston, Texas, where I dove into the world of corporate engineering. And that was the end of my kind of top path. So from there, I was kind of like left looking at the future, like, all right, what's next? What's this next milestone? Because up to this point, I'd always had some kind of milestone to check off, right? Like get into college, get a good GPA, get a good job. So now it's up for me to kind of figure out the rest. And that horizon was quite long, at least I hope. So kind of led me into the world of kind of personal finance and real estate. I just kind of stumbled into it. Thought this real estate thing sounded really cool. Now that I was having to work and earn my own money, I thought, hey, how do I stop selling my time for dollars and start scaling this thing on the side? So I started buying real estate in my home state of Oklahoma, started with a really cool small deal and kind of been growing it and scaling it ever since, doing it on the side. And along the lines have stumbled across my passion.
Awesome. That's an awesome story. So your first deal, was that like a single family home? Could you talk about your first deal?
Like so many people, is a single family home. The numbers are kind of crazy because they're super small, but this was in rural Oklahoma. So I bought the home. Is a 1 bedroom, 1 bathroom, A-frame style home. I bought it for $25,000, which is kind of a mind-bogglingly low number, but this was not like in the slums of Detroit or anything. This was a rent-ready, nice home. It was a lake cabin. And so I bought this deal. I got conventional financing somehow. At the time, I didn't even know that was supposed to be a hurdle, but I put 20% down. So I put $5,000 down, all in closing cost. I was at like $7,500, $8,000, which was a good chunk of change for me at the time. And my mortgage, I can still remember this day, was $141 and some change. And so looking back, that's essentially like your cell phone bill, right? But I think the mentality I had about this was like, I'd heard about this concept on a podcast just like this, Beau, and I thought, well, I'm not so sure this is what I really want to do. So I'm going to go try it out small. And there's all kinds of advice out there. Start big, start small, whatever. But I think just do what works for you. For me, that was like, hey, if this thing goes south and I can't find a renter, I'm going to at least be able to pay the mortgage on my own. It's not going to like financially cripple me, right? So I did a lot of cool things with that deal. I did some seller financing with it. I sold it on seller financing. I rented it out for a few times. I eventually ended up selling it and kind of moving into the multifamily space. But so many lessons learned on that deal, cut my teeth in it, and really decided at that point I was going to be a real estate investor.
Cool. So are you still an engineer?
I am.
Day? Okay.
Yeah. Still rocking the day job. And I'm not one of these guys who I really hate my job and I have to get out of the rat race. But I know that one day I want to have the freedom to leave if I want to and just kind of work on my own terms.
That's cool. Yeah. I mean, I think so many people are like, oh, let's leave the 9 to 5. And but at the end of the day, it actually helps you grow your business a lot quicker, right? Like if you really think about it, you're more bankable because you have solid W-2 income right. So I think too many people rush into I'm going to go full time, and maybe that's not the best option. And looking back, because I've always been commission based, I always go, should have just built the base right early, and then you have so much more flexibility as opposed to rushing in. Because as self-employed, even these borrowers that I'm dealing with today nowadays, they make tons of money, but they have so many write-offs, and they can't. They're not good on paper, and they can't. It's hard for them to get bank financing, which is in our world sometimes is a big problem if you can't get long-term debt. So it's definitely, I would just say I'm glad you like what you do, and you also are able to balance having your own podcast, looking for deals, and doing some value add deals. So you keep yourself busy in a nutshell. But let's kind of dive into the seller finance deal we talked about 2 weeks ago, because I think people love this stuff. They want to hear how normal guys can, talk to sellers and get them to sell on terms. So let's kind of jump into it, how you found it, how you structured it, and the negotiation process.
Yeah. Okay. So this is a fun deal. I'm still in the middle of this deal. It's been a pretty heavy value add. So I'm kind of on the tail end of fixing it up. So all the numbers are pretty fresh, but this was a really exciting deal for me. This was an 8 unit, which is to date, or at that time, was the largest deal I'd done. And we'll just kind of jump in the nuts and bolts. This was in one of my home markets, market I invest primarily in, Oklahoma. So I knew the specific property and I knew I wanted it. It wasn't like I found it through a direct mail campaign or something like that. So I looked up public records. I found out who owned it. I contacted this person, and this property was terribly run down, very, very neglected. Hope the listener's not listening in, or the seller's not listening in. But so this property was, in dire need of a lot of TLC, if you will. So I got up the nerve to call the guy, and I said, hey, my name's Jacob. I own several properties in the area. And, I just, decided to, pitch him on would he be interested in selling. And he's like, well, it's funny you ask. I was just talking with my partner and we're interested in selling. I said, okay, great. And I knew going into this thing, I wanted to structure seller financing, because just looking from it and talking with people like you, Beau, I know it's not going to be bankable or lendable rather. So I read this book called Exactly What to Say. And this book is pretty much just I think it's 20 some odd phrases. And these phrases, I just kind of built together this script, and I'll give you a few of them. And they are phrases like, I'm not sure if this is for you, but insert pitch here. And what does somebody hear when they hear that? They don't hear anything you said before the word but. So I could say, Beau, I'm not sure if this is for you, but, and all of a sudden your ears kind of light up. You're like, but what? I thought, insert, your phrase here. Or here's another one. How open-minded would you be to hearing about ... XYZ? Well, no one's going to say, no, I'm not open-minded. I don't want to hear about your idea, right? So I kind of just took all these phrases from this book, built this script, and I had everything all planned out. And when I called them, I didn't hit it 1, 2, 3, 4, 5 phrases in a row, but I worked them in a little bit. So I took all these phrases, and if you read this book, it kind of goes into the psychology of what these phrases mean and what they trigger and why to use them and when to use them. So I really had my ducks in a row, and I called this guy, call him, hit him with this seller financing pitch. It goes really well, and he's receptive to the idea of seller financing. Now, this was my very first seller financing deal I've executed successfully. I'm always trying to pitch it, right? But very, very doesn't work very often, in other words. So Yeah, we negotiated some terms over the course of 60 days. We're kind of working on some terms, working on some sale price. So it kind of came down to one of these things: his price, my terms. So I gave him his asking price, which was more than I was willing to pay for it. And, I started my due diligence on the project, started getting into the units, seeing what they looked like. Some of them were total remodels, some of them were cosmetic, remodels. And so the terms on that deal, if you want to get into it.
Yeah. Mm-hmm.
I bought it. When I bought it, it was a 7-unit. We turned it into an 8-unit. I bought it for $160,000. I negotiated at 0% down, a 15-year note at 5.25% interest. So my mortgage payments on that are like something like $1,286.
0 down, 1286. So you just did like a 30-year amortized loan.
Fully amortized 15-year.
15 year.
Yeah.
Okay.
Pretty straightforward. So nothing crazy, no interest only period, just pretty straightforward.
Did you have to come out of pocket with closing costs or anything?
Yes, I did. I paid an attorney to draft up the seller finance contract. I did some title work. I paid the attorneys to do title work and, doing escrows and stuff like that. So all in all, I'd have to go back and look at those numbers, but it was less than 5,000.
Yeah. I was going to say probably like 4K. All right. Yeah. So that's like amazing. And then obviously you had to do some value add. And why don't you walk us through like what you're going to be once you're done, how much cash in you're going to.
Yeah. So this was a story of, this owner just had too many irons in the fire. He was a home developer. He wasn't really a landlord. This property wasn't near to any of his other projects. So he just wasn't giving it the attention it needed. And as such, it kind of spiraled downhill and tenants were not paying rent. One of the units just flat out didn't even have a front door on it. It was totally vacant, right? So, this thing is rough.
What was the occupancy level when you took it over though?
3 out of 7 units were rented and nobody was paying consistently. Like people were paying like weekly, 3 months behind, on rent. So, this was a pretty big like risk for me. And going into it, I did a lot of things to mitigate my risk, mitigate my downside. This was the first time I took title in an LLC. So that was a cool new thing for me. And I thought, hey, if this thing goes south and I can't get it stabilized or whatever, I've got title in an LLC. I've got 0 down. I put $4,000 or $5,000 down in closing costs. Like my downside is very minimal. So it gave me the confidence and the ability to really kind of go on and take this project on. Now, when I bought it, the 3 units that were occupied were renting at $400 a month, which might sound low to some of your listeners, but in that market, it's a little lower than market, but ballpark about there.
And that's just like a normal tenant, not low income Section 8.
Yeah, just normal cash paying tenants.
Okay, that's good. Okay, so three out of the 7. So, okay, so. I got it. So you might be lucky to break even initially. So you got to feed
it's
it.
like barely breaking even. I'm feeding it a little bit, plus sinking a bunch of money into it for renovations.
So obviously you did your due diligence, and what were you figuring like your total spend would be on the property?
It's funny. I learned a lot about this process. At first, I'm like, okay, I'm going to bring all these units up to $500 a month rent. And to do that, I think I need $4,000 in this unit, $1,200 in this unit. So it's like kind of all over the board. But I think going in, I dramatically underestimated what we've actually ended up doing, because we've brought it up a little bit notch higher than we initially had planned. And so we are estimating to try to get rents to about 500, 525. And we're actually at about a 625, 650 rate right now. So
that's a good problem. So, but how much more CapEx did you put in that you anticipated? Is it going to be like 20,000 or 30,000?
It's going to be about a $25,000 CapEx project for the entire
total
project. Yeah.
And what were you originally thinking?
More like 12 to 15. We were kind of thinking more of like a cosmetic, level rehab. And then we've really gone in and taken a couple units down to the studs.
Okay. So far I like this deal. Okay. Let's just recap, because I think this is really important especially for obviously like the newer investors that don't have much money. And the funny thing is that I know experienced investors with tons of money that just all they do is seller finance. It's just, but this is kind of like a lot more lifting, if you will, because Jacob's doing a lot of work on, his team is, it's not like he's not managing this process. So he's putting a lot of hours, sweat equity in the deal.
Oh yeah.
But it's an interesting deal because they're out there, and I that's why I kind of want to break down this story, because it's like I don't know, there's not enough shows or episodes you listen to where they're like, okay, how'd you do it? Like, what was the thought process? How'd you find it? And I think we're just kind of narrowing, honing in on this. And then the end of the equation, obviously the story's not over because you're still, 3/4 of the way done with the CapEx, but it's the positive side is, yes, you spent 10 grand more on CapEx, but rents are now they're $150 or $125 more per month per door, essentially.
Yeah. So when I bought it, it was bringing in about $1,200 a month, assuming everyone was paying right, which was not the case. At the end of this project, it's going to be bringing in $5,000 a month.
Okay. Yeah. So that's incredible, right? So, 5,000 a month, right? So, and then you got, in theory, you don't need to refinance, but realistically getting capital back to do more of these projects makes more sense.
I'm going to have so much equity in this deal by the time it's stabilized, Beau, that I'm looking to refinance it and pull out not an insane amount of equity. And I'm not trying to leverage it to the hill again, but I'm looking at doing a 60 to 70% loan to value ratio refinance and pulling out maybe about 150,000 from it. So I think on the back end of this project, it's going to be worth in the ballpark of 450,000.
Yeah. So 450. So, and you're going to be all in at 160 plus 25 plus 5 for closing. And then,
let's call it like 200,000, just a little shy of
200K. So you created $250,000 of equity.
Yes.
And how long would it take you to save that at your day job? A couple of years.
Yeah. A few years for sure.
Yeah. Like, it's pretty hard to save $250,000.
Yeah.
So that's the power of what I call multifamily. I call it Burr 2.0.
I love it. Yeah.
I coined that name. If Brandon Turner's listening to this,
he is.
But yeah, he sure probably does. That's where he gets all his content from. But I think the story here is really cool because it literally didn't take much cash at all. I mean, you could really put it on a credit card. And what it took is took some kind of like, okay, I've driven by this property. I know it's a potential good deal. I researched the owner's name. I might have to do a reverse lookup or find his cell phone. There's many tools out there that help you do that. You pick up the phone, you call him, you introduce yourself, you have a conversation. At the end of the conversation, he indicates he would be interested. He spent the next 2 months doing due diligence and negotiating, and he wanted 160. You wanted to originally pay probably 125.
That's exactly right.
How do I know this stuff? You know what? I have this sixth sense. Really, I do. And then you said, okay, well, if you finance the whole deal, and you do a 15-year term, no money down at 5.25%. We got yourself a deal, right? Because you're exactly right. All of my mentors in real estate, they've always said, okay, well, you can pay their price if they take your terms, right? And that you can essentially overpay for properties as long as they take your terms.
Yeah, for sure.
Right. And obviously you didn't overpay for this property. But going in, you were going in like a cash offer, at a 125 cash offer, right?
Yeah,
but
exactly.
Instead of borrowing and paying all that cost or bringing in a partner, it just makes more sense to have the seller finance it. And so the seller, you didn't put any prepayment penalties. If you pay him off in a year, it's fine. He doesn't care.
No, he's cool with paying it off early. He just wanted, somebody to take over this headache, and he was happy to do the deal.
So, okay, let's kind of dive into taking over this headache, because I have some headache properties myself, and they're far away and they're a headache. But okay, I know you got boots on the ground because it's where you used to live, so that's obviously a big help.
Yeah, totally.
But what was the strategy going into this? The strategy going in, like, okay, we got to review these leases on the 3 that are in there. They're not paying. Like, how do you send the message like, hey, there's a new sheriff in town, and this is how we're going to roll. And then how did you then from there, if you can talk on how you like, was the goal to like fix one by one and then rent them out? Is that kind of the way to do it? And then the income increases, you can start rolling some of the income back into the CapEx.
Yeah, exactly. So, day one takeover, it's knocking on doors saying, hey, I'm the new property manager. Here's how we're going to set up rent collection systems, blah, blah, blah. Here's my contact information if you need anything. And then from day one, immediately we started with exterior CapEx projects, painting, parking lots, windows, new doors. So all of a sudden, within like 30 days, it's cleaned up outside. We put a door on a unit for a start, right? One door just had plywood, drilled into the door frame. So, take that down, put doors up, paint it, make it look like somebody lives there and somebody cares. And just doing that simple thing, one, it helps the curb appeal, and two, it lets the tenants know there, hey, no more of this business of just paying whenever you want and being 3 months behind. We expect rent on the 1st, due by the 3rd. This is how it's going to be going forward. And people that don't want to play on that system, they move out. And people that are like, okay, we can do that, they stay. And like for the renovation sequencing, it was just a 1-by-1 unit after finishing up the exterior first. So we wanted to kind of get that curb appeal up so that we could convince somebody to actually live there, right? Because in its current condition, it'd be like, I'm not even stopping at this place if I drove by. So 1-by-1, and they needed different levels of kind of renovation. So, some had really good flooring and, fully functioning kitchens, and it was just painting, fixtures, new hot water heaters, things like that. And the one that had no door, surprise, surprise, it wasn't in great shape. There were like literally stray animals living in it. So it was a tear down to the studs, the whole 9 yards. So anywhere from pretty good to terrible.
So you got like 3 more units, right? Before you're done with.
I'm currently finishing up 3 of them right now. Yeah. And those are, so it's funny. This building is a 2-story block construction building. It used to be 8 1-bedroom apartments. At some point in the past, they took 2 of those apartments, turned them into a 3-bedroom, 2-bathroom apartment. So then it turned it back into a 7-unit. And I knew all along that'd be a pretty big project to tackle, to take that apartment back to 2. So I started trying to advertise this 3-bedroom apartment, and I couldn't get double the rent of what I was charging for the 1-bedroom. So say I was getting $600 for the 1-bedroom, I was having trouble getting even $900 for the 3-bedroom. I'm like, why don't I just take this thing back to 2 1-bedrooms and get $1,200 for the 2 units as opposed to $800, $900 for the 3-bedroom? It's like there was a better and higher use of that space. So that's what also increased the CapEx budget. So, and the renovation timeline. So we've done that. And then we're just finishing up what I call like the dilapidated unit, the one without the front door. So
are you going and doing work yourself? Are you handy, or, are you just outsourcing all that?
Yeah. So my dad is my partner. He's my boots on the ground. He's kind of a general contractor, and we've got a couple in-house kind of handymen that are helping us. We've got some, plumbers, electricians. We've hired sheetrock crews to come in and do all the sheetrock. So, I'd say we're kind of keeping it somewhat in-house, but subbing things out.
But your dad's there kind of regulating.
Yeah. And I'm just kind of quarterbacking it from 500 miles away.
Yeah, no, I think that's the key though. Like if you can have boots on the ground, I mean, on the kind of the smaller scale, right? I mean, if you have big projects, you're hiring but the handyman and the subs are very difficult to, because you're dealing with a certain character, and getting things done is just very challenging.
I got a whole bunch of stories about hiring the wrong people too. So, but yeah, you're right. I mean, having the infrastructure there, that's why I invest there, is because maybe it's not the economics or demographics of this small submarket I'm investing in. It's because I've got the infrastructure and I've got a leg up on the competition, and I can see these higher returns because of that systems and kind of infrastructure I have there.
That makes a lot of sense. Yeah. I mean, I always say, because I've been buying in the Midwest, and I go, it's a gold mine there, but the problem is if you don't have the infrastructure, you can't really operate successfully there.
Yeah.
So it's all infrastructure. I mean, you can invest anywhere. I mean, people need places to live, as long as they can pay rent, or if it's subsidized, then you're going to be fine, right? Like there's a shortage of housing almost everywhere right now in the U.S. So
Yeah.
I think it's good to be a landlord. Anyways, next few months, basically, you're going to have this stabilized. You're going to refinance. You're going to cash out. Probably put 150 grand in your pocket. Get long-term fixed rate debt, and then move on to the next one.
Exactly.
And then what is your what's your kind of strategy going forward? Like, I mean, obviously, like if you can find another deal or two like this, it's really going to be easy, because you don't have to put any huge capital into it up front. Is that kind of your strategy for the next couple till you build your baseline up?
Yeah, but I think especially my neck of the woods, is in dire need of affordable housing. So I really like that space, that asset class, that kind of C plus, B minus kind of, multifamily. I like kind of the smaller to mid-sized deals. I think you're kind of flying under a certain level of radar at those, being able to buy them from mom and pop operators. So kind of like that 20 to 60 unit space. And it's a bit of a no man's land. There are some cons to those properties. Like they're just right on the cusp of not being able to really justify full-time on-site property management. And I acknowledge that. That's definitely a challenge. But at the same time, you get some of those mom and pop operators have had these places for 10, 20, 30 years. And you can negotiate these seller financing terms or find them a little bit easier than you can these 100+ unit deals that every investor group in the country is going after.
No, I definitely see it. And since I'm on the lending side, I see a lot of borrowers finding these, like yourself, finding these great deals. I mean, where else can you build $250,000 net worth, to add to your net worth like this, right? It's pretty hard to do. I mean, this is what I could definitely say is a definite solid double or triple, right? So, if you're hitting base hits, that's great. But if you're hitting a triple, that's even better, right? When you find these deals.
For sure. And this thing, it sounds lucky, and it totally was. But keep in mind, I've pitched seller financing 100 times before this one ever worked, right? 99% of the time you pitch seller financing and the seller doesn't really want to do it. They want their money now. Now you've got to find unique properties, unique circumstances where seller financing is more likely to work. And that's, these distressed scenarios, whether it be property distress or seller distress, but those are where you kind of have a little bit better luck. But, I pitched seller financing 100 times before this one worked out. So, it doesn't always work that way.
So you're pretty active. I mean, you're not like an investor that's made a couple offers. It sounds like you really you're pounding the pavement pretty hard.
I might be tooting my own horn on saying 100 offers, but nonetheless, I've definitely offered a lot with seller financing. But yeah, I'd say I'm pretty active. I'm constantly looking at deals, constantly trying to do more deals, but I haven't done a ton. It's like these multifamily deals, they move a little slower. They're far and fewer between. But yeah.
What are you doing for deal flow? Like as you're like right now, obviously you're probably rushing to get this done, but what's your advice to like start, as somebody that's listening to this, what should they be doing to like find deals?
Yeah, I think it starts with just telling people what you're doing, right? And you think, okay, that everybody says that, and I've been doing that, it's not working. I've got a perfect scenario of how this worked out. So all of my deals, I don't think I've ever bought a single deal on market per se, but one time I bought a duplex, and I'll answer your question, but first I want to tell the story. I bought this duplex, and how I came across this was my 80 some odd year old grandpa is out metal detecting with one of his metal detecting buddies. He's not tech savvy at all, doesn't have a cell phone, is not tuned into the real estate world. He's watching World War II movies right now on the History Channel is exactly what he's doing, right? So he's telling his buddy, oh yeah, my grandson just bought a duplex over in the next town, blah, blah, blah. And he says, well, I know a duplex over in this town that Becky and Susie are looking to sell. So my 80-year-old grandpa, I'm not tuned into the world of real estate investing, doesn't have a phone, no Facebook, nothing, says, hey, I heard about this duplex, right? And all because I'm talking about it and I'm doing it. So yeah, I mean, it was a family referral for sure, but that's how I got a duplex. So
That's
how I'm
like
looking,
Brent Daniels. I don't know if you ever seen YouTube him or look him up on YouTube,
okay.
but he has a T-shirt and he has like a coaching program, but it's TTP, talk to people. That's his whole model, and he teaches people like basically how to talk to people. But it's funny because people pay him to teach them how to talk to people, but there is an art to it, right? Like you have to learn how to, I think we all have like doubts in our mind, right? When you're about to pick up that phone, you're like, oh, I don't want to do this. He's going to hang up in my face. I'm going to get rejected. And nobody likes that feeling. But I think practice, right? Like you just do it and just know, hey, it's going to take 10 or 20 no's to get that one yes. But when I get that one yes can be 250 grand, right? So
For sure. And don't approach it from an aspect of like you're asking for something and you're expecting a handout. You're there to provide a solution. Like this owner that sold that 8-unit to me, you think he's happy that I'm paying him 5.25% on his money and he no longer has to chase down these tenants and worry about that property and what's he going to do with that front door that's boarded up? No, he's just making money on the money he lent me. He hasn't been to that property in a year and he's just smooth sailing doing what he's good at, developing homes.
yeah. And that's that's true, right? Like to him, this was like, hey, it's a thorn in my butt, but for you, it's like this is like a treasure.
Yeah, exactly.
What? And so that's the way you have to look at it. So what's the next 12, 24 months look like? It sounds like going a little bit bigger, the mom and pop 15 to 60 unit type properties. What kind of marketing are you doing? Are you using any tools to find data and that kind of thing? I'd like to learn about that.
Yeah, absolutely. So the next 12 to 24 months, looking at, growing, bringing on partners, I've been spending the past 12 to 18 months really, networking, growing my, sphere of influence. I host a podcast. So that's, allowed me to meet a lot of really cool people just like yourself, Beau. As far as, deal flow, how I'm finding deals, really looking at off-market deals. I do maintain broker relationships, but a lot of these properties I'm targeting, sometimes they come across brokers' radars, and sometimes, there's some good deal flow from that. And then on the other end of the coin is, looking for off-market deals. I like a tool called PropStream. I've been playing with it for about a year now. And, it's like just one of these public records kind of databases where you can go and pull and create lists, look at ownership records, find personal contact history, even do kind of mailing campaigns and skip tracing and things. So you can really be very targeted in what you're looking for. So that's a really cool tool that I like to use.
Will it allow for you to pull like multifamily up?
Yeah, it does. It does a pretty good job at it. I found that, it's got some quirks to it. And it's just really, I think what it boils down to is how your county tags properties. Some counties do a better job at identifying, hey, this is a 5+ unit, this is a 2 unit, this is a single family than others. But in my area, it does work pretty well.
Cool. I use Reonomy. Ever heard of Reonomy?
Yeah, I have. Mm-hmm.
Yeah. It's a little pricey, but I use it for finding loan opportunities, but also sometimes because the data is pretty good. And then I want to check out. There's another one that's called Prospect Now that looks really good too.
Okay. Yeah, I think there's that, and another one I heard of, and I just talked to the guys that had founded it, and the software is called Property Radar. That's it. So yeah.
Yeah, Property Radar. That was been on the West Coast for a long time, actually.
Okay. Yeah.
It started as Foreclosure Radar. Sean O'Toole and Aaron works there.
Yeah. I just talked with Aaron. Yeah.
Yeah, and Aaron's dad actually is Bruce Norris, and Bruce Norris is like an amazing. He has a hard money company. He builds houses. He's a big private money lender in California. Then I think he moved to Florida.
Oh, okay.
I think he moved to Florida like a couple of years back, but
okay, gotcha.
But he's like the guy that people call to get predictions on the real estate market. He's like that knowledgeable. And I remember, because I'm older than you by a little bit, I'm 43. I know I look like I'm 30, but I'm 43. But when I was young and dumb, I should have listened to Bruce Norris, because it was 2005 or 6. I went to one of his presentations, and he says, the market's going to collapse. The market's going to collapse. And then 2007 rolled around, and what happened? The market collapsed worse than it's collapsed since the Great Depression, as far as real estate, right? And so, he's a really good person to follow about, market cycles and things. So you should definitely look him up, because I'm a big fan of his. But yeah, I'm interested to see what's going to happen over the next couple of years, because I do think, like, not what you're doing, right? You're doing something that's like you're forcing appreciation, but I do see am I allowed to say shit? No, I don't know.
Your podcast.
Yeah. But I never say shitload, but there's a shitload of syndicators out there right now. I see them advertising everywhere, and it's almost kind of gives me the vivid flashbacks of like the 2007 days, right? Like where people are overpaying for stuff, things like that. People are, putting their numbers in that they're doing these value add deals, and then they're not able to execute the plan, right? Like, and then they get stuck in a bridge loan, they can't refinance, and they get, right? Like those kind of things are going to happen because we're at like the lowest rate time right now, right? Like, so don't you think, like, if you were to look at it, like a lot of that's going to be coming back on the market here in the next 2 to 3 years, like as rates move up? And I mean, you would have to think that's going to happen, but nobody's got a crystal ball.
Yeah, I think about it a lot, Beau, and I'm not one of these guys that has like this grand kind of macroeconomic crystal ball, but I definitely try to follow those guys that tend to do so, and find it fascinating. You're right. There's so many syndicators out there. I call myself a syndicator. I started out, my podcast with the intro. I'm a syndicator. Truth be told, I've yet to syndicate a deal. So I'm just, I don't know, a liar, or, wishing it into existence. I don't know what, but yeah, there's some unique times ahead of us, I feel, for sure.
Yeah. And now going back to your property in Oklahoma. So you guys are self-managing then?
Yes.
Okay. And at some point, will you hire a property manager?
Yeah, we're starting to get to that point where it's taken up a lot of time. And, to be honest, I didn't get into real estate investing because I enjoy property management, right? And, it's a very labor intensive activity. You're constantly dealing with leasing requests and property showings and, managing leases and taking care of maintenance requests. And it's not my favorite activity out there. And I think once I kind of grow and get to a scale of where I can turn stuff over to a third party property management, I haven't decided whether I'm going to create a property management business, and kind of try to make that operate on its own, or just hand it over to somebody that's already doing property management way better than I am.
What about any other interest in any other asset classes or different investing methods? Are you doing any land, any like mobile homes, or anything else that interests you?
Yeah, I looked a little bit at mobile home parks. They're just so far and few between, even though in Oklahoma, they're a little bit more frequent than other parts of the country. And I like self-storage, but, there's people out there that are just doing those things way better than I am. And I don't feel like I've got an advantage over anybody at this point. So right now I'm just really getting started in my investing journey. I'm just trying to kind of have a narrow focus, but I'd be lying if I said, yes, mobile home parks and self-storage don't occasionally catch my eye and I pretend I know what I'm doing and I try to analyze them.
So what does your day look like? Do you early riser, you stay up late? What does the day look like when working your day job and then also your business?
Yeah, sure. So yeah, I'm an early riser. I have the fortunate, situation right now to have been working from home over the past year. And before that, it was still pretty flexible. So I'm working a day job, 40 hours a week. I've got a unique schedule and I work 4/10s, which means I work Monday through Thursday, 10-hour days, all remotely. So from this same desk, I just flip open my work laptop and I'm at my W-2. Shut it, flip open my personal laptop, and I'm at Ayers Acquisitions. So a typical day for me looks like waking up pretty early, probably going to jiu-jitsu at 5:30 a.m., coming home, having some coffee, kind of getting my day started, writing goals. I'm pretty religious about kind of goal setting and writing my goals, do a couple hours of personal stuff, boot up the old work laptop, hustle away at that for a while. And then, throughout the day, if I need to take a call here or there, it's no big deal. I can call my dad in Oklahoma and see, how the project's going, or, call you, Beau, and shop, refinance rates or something. Right. So, 5 o'clock, shut the work laptop, go back to heirs acquisitions, finish up the task from the day, and then I usually turn it in pretty early. I'm not one of these, I don't pretend like I hustle 16 hours a day. I'm a 5 a.m. to 7 p.m. kind of guy. So I'll knock out a 14-hour day, call it good, cook dinner, unwind for the day for an hour, try to do a little reading in the evening, and rinse and repeat.
So how long have you been doing jiu-jitsu? Long time, or just?
About 2.5 years. I'm a blue belt.
Oh, nice. I was a blue belt. It's one of my other big wishes is that I wouldn't have stopped my jiu-jitsu career, but I started training jiu-jitsu when I was a senior in high school. So this was a long time ago. And then I only trained for like 4 years, but basically I got my blue belt, and I trained with Cesar Gracie in Pleasant Hill, California. And actually at that time, Cesar and Half shared an academy, Cesar and Half Gracie. Then Half has his own academy and things, but but Cesar spit out a lot of amazing fighters, right? Like Gilbert Melendez, the Diaz brothers, Jake Shields, all that stuff. So, but they were kind of after my time. When I got there, I didn't even know those guys. I think they were just getting started. And it's been amazing to watch the sport grow, and especially like UFC and things. But Gil Castillo, he fought in the UFC. I used to train with him. And then Dave Terrell was really good. I'm still a big fan of the sport. So
I could go on a tangent about how jiu-jitsu relates to real estate, but that's probably another podcast. But just a point, Beau, you said, you wish you would have kept going. Get back into it, man. You won't have quit. You just would have taken a 10, 20, 30 year break, whatever it is. So get back to it.
I once in a while, before I moved to Nevada, when I lived in California, my other friends worked out at another gym there, a Muay Thai gym, but they also had jiu-jitsu classes. So I went in there and occasionally would roll a little bit. And, it's good because I was a good wrestler. I didn't wrestle. I wrestled when I was really young, and then I probably should have pursued wrestling. I probably would have been really good. But anyways, still have a little bit, but it's still humbling because I'm a lot stronger than a lot of guys when you get tapped out by a small guy.
Yeah, for sure. So here's just one translation I'll make between jiu-jitsu and real estate, and I won't go on a tangent, but we kind of talked about overcoming that fear of picking up the phone and calling a seller, right? Well, if I wake up early in the morning, go to 5:30 a.m. jiu-jitsu, get strangled for an hour, and then I'm looking at my emails for the day, or I'm looking at, hey, who do I need to call? Nothing seems so bad after that. It's like, I just got strangled for an hour. I can handle a phone call. That's cake, So that's just my little kind of motivation for getting through the day.
I totally agree with you. I mean, you talk all day long, I'm stressed out trying to close deals, whatever. And then, just imagine you go and just beat yourself up at the gym. Then you're like, why am I so stressed out? Right. Like you just, you're like, I just was going at it like full speed fighting somebody. And, then that's the one thing I do miss was that you're kind of at peace after that, right? Like you just had a grueling workout. You just we're trying to, way off getting strangled, and now the rest of the day is easy, right? So I love that. I love what you just said. But why don't you, we dove in pretty deep. Why don't you talk about your podcast and how people can get a hold of you and find you and all that good stuff?
Yeah. Thanks for that. So, I've been doing the podcast for maybe a little over 3 years now, 370 some odd episodes in. It's been so fun doing it. I get to talk to so many cool people, learn right alongside with the guests. When I first started, I was so green, didn't know anything, and just being able to, to be able to get to talk with people and meet cool people like yourself, though, it's been super rewarding. So I'm having a lot of fun with that, growing it, talking to new people all the time. It's called The Real Estate Way to Wealth and Freedom. I'm not a marketing guy. That's why I named it an entire sentence. So that would be easy to repeat 100,000 times in the next few years. So it's a mouthful, but you can find it anywhere you can find podcasts, Google Podcasts, Apple Podcasts, Spotify, the whole 9 yards. And you can reach out to me. I'm always obviously happy to talk real estate. Love doing this stuff.
Well, thank you very much. And I'd love to have you back and we can talk about the deal, 6 months from now and how it went.
Yeah, I love it. Well, thanks so much, Beau.
Thank you.
Thanks for listening to the Investor Financing Podcast. For show notes and useful resources, please visit investorfinancingpodcast.com. For questions or comments, email info@investorfinancingpodcast.com. If you enjoy our show, please share it with your network. Until next time.